Welcome to News You Can Use, presented by Supreme Lending. News You Can Use offers timely information related to the housing and housing finance industry that we believe will benefit you and your customers. This is News You Can Use.
Hey, welcome to News You Can Use. Today it's March 15th, 2021, and we are so blessed to have Doug Duncan, our good friend, chief economist with Fannie Mae today. His forecasting day, he just put out his updated forecast for 2021 for housing, and we're fortunate to have him here to share the details about it. Doug, welcome to News You Can Use.
Thank you. Thanks for inviting me.
Let's start out with the basics. What are the fundamental economic ideas that drive the housing marketplace, Doug?
Well, first of all, it's people. So your population and the nature of the demographics, how their age, household formation, all that. It's people. Second, it's people with jobs and income. So employment is key. And then third, really is how many houses are available that are new or that are existing and people are trading out. And then, of course, interest rates and affordability become an issue related to, or I should say, interest rates and house price interact as they are today in a really strong way. And so those things all impact the ability to afford if you are a household who's looking to own a home or to trade up or down.
So the demographics idea is kind of the key fundamental. How many households are we forming every year? Where are they moving? Where are they living? So we feel always like in the Southeast, we're in a pretty good place because it's warm and there's jobs. So people are moving here more than moving north, that's for sure. Your principal or one of your principal responsibilities with Fannie Mae is to forecast. And today is kind of forecasting day, right? So you put out a new forecast. Why don't you give us an update with regard to 2021, where we started the year and kind of where you and the team at Fannie see us at this point in terms of how 2021 is going to lay out from a housing standpoint?
Well, it's going to be a lot like 2019, actually. If you remember back to 2019, we finished the end of 2018 with the 10-year treasury up around 3%. And then we started this downward drift as the Fed eased again. And then we went into the pandemic and the 10-year got down to 50 basis points. Now it's come back up to about 160. But the average from 2011 to 19 was about 2.3. So we're still well below that, which means rates are still good and spreads have come in. So whereas the 10-year has come up, the 30-year fixed rate mortgage hasn't come up as much because there was such a huge volume in the middle of the year in 2020 that companies simply didn't have the capacity to do all that volume. And so spreads widened as a low management. So those spreads are narrowing. So 10 years coming up, but the mortgage rate not going up as far. It's going to be a good year. We think total home sales about 6.85 million, which is about 6% more than we had in 2020. So that's sales. The refinance side of things obviously is going to be impacted by the rise in rates. So we think maybe around 2.1 trillion total refinance and about 1.8 trillion purchase mortgages. But of course, that really depends on how much of the rate rise that should be expected based on the growth expectations are already in the market and whether the market has gotten that right.
So 7% growth last year, a little bit better in 2020 in housing sales, 6.9 this year. What should the annual run rate be for housing sales, all things considered? If we're driven by demographics, and we know the ebb and flow of employment and interest rates, all of those have on the margin some impact. But what should we see kind of in our industry in terms of annual sales, all things being equal?
Yeah, we're probably well above what would be an average level, but you mentioned demographics. We're at the peak of the millennial home buying age, and they're the biggest population group we've ever had. And with interest rates at historically low levels, it's not surprising that we're seeing 6% growth. We would see even much more than that were there more homes available for sale? But with inventories at 1.9 months, I mean, that's the lowest since we've recorded those data. So it's simply the availability of homes for sale is what's holding the numbers as low as they are, and they're not low; they're strong. So a couple of percent a year is would probably be more reasonable.
Right. So maybe 1.5 to 2% kind of rate. So you look for adjustments then. If you're at 6 or 7%, you do look for an adjustment at some point to kind of bring us back in line on the average, if you will.
Yeah, and we think 2022, we think, well, actually sales will be down, not just slowing, but actually down from 2021.
And for our viewers, don't get the idea you need to jump off a building. We're only talking about
from huge levels.
Right, we're at very high levels, which is 6 and 7%. Our industry being driven by demographics, being down 2 or 3% on the margin for a business industry-wise, not such a big deal, right?
That's right. That's
this
right.
Topic you brought up, millennials. So they often get talked about, right? They're just people, but do they show any sign at all of having any difference in terms of interest to own homes versus previous generations?
There were stories told about the boomers that weren't true. There were stories told about the millennials that weren't true. Nobody talks about the Gen Xers, so they're apparently not very important. But everybody said at the outset of the recovery from the 2007 to 9 period that the millennials have learned the lesson. They don't want to own a home. They've seen the foreclosures and the loss of wealth. Our surveys said, the first survey we did nationally was June of 2010. 92% of millennials said they eventually want to own a home. They're no different than any other population group with regard to wanting to own a house. The question is, what kind of house will they own? And some current things to think about is, how does the work from home that we have learned during the COVID, how does that play out in the future? One of the things that people were concerned about was all the boomers owned these 4-bedroom homes in the suburbs, and the millennials were getting married and having 1 child or maybe 2. They didn't need 4 bedrooms. What happens to all those houses? Do prices fall? Well, now the average house price expects 2 incomes in the household. And if you have 2 working people and they're both working remotely, 2 of those bedrooms get converted to offices, and voila, there you are. That absorbs that supply. And so you're seeing that. That's part of the reason sales are as strong as they are, is people are moving out. And since the boomers are doing what they said they were going to do, which is age in place, the existing home availability isn't doing the job. So the builders are building as fast as they possibly can. And that's leading to price increases in inputs and availability of land and all those issues. So millennials, no different.
So listen, I know as a forecaster, you use logic and ration, right? And you use inputs. I reflect back on 2020. We started the year 3.5% interest rates, 3.5% unemployment. And then we have this thing, COVID, and we shut down the entire economy. Interest rates go down, a good thing. But then we see unemployment go to 14.8. We lose 20 million jobs. And we wind up with a 7% increase in housing sales as opposed to 2.7 starting the year. As a forecaster, tell me what it was like to process last year.
That's you're going to forecast often, I guess. The month that was the most difficult was the month of March, because it was very unclear what the breadth and depth of the impact of the virus was going to be on human behavior, because there was no data on which to draw conclusions. So our thought was initially, well, house prices might fall 1 or 2%. They're in a pretty good spot, but activity is going to stop. Then in April, when we saw the March survey of consumers, we recognized that the fact that it was more dangerous for older people means existing homeowners, because new first-time buyers tend to be significantly younger. than existing home owners. So with rates falling and the impact of the virus on discretionary spending by middle and upper income households, it was going to be hourly wage workers that were going to be impacted. And the people that could offer a house for sale were more concerned about the virus than those who saw the emergence of low interest rates. So we went to the board in April and we said, we think house prices are going to rise. And they're like, why would you think that? And we said, because even though the total number of transactions will fall, supply will fall further than demand, and that necessarily means price will rise. So we got that right in April. And that's turned out to be, the 3 rules of forecasting. If you give a number, don't give a date. And if you give a date, don't give a number. And then if you get it right, don't look surprised. So give us the month of March. We had to adjust everything because of the unknowns, which was, the virus is not an economic variable. It's a health variable. And economic models run off past information in economic variables. So last year was the year of the virus. This year, 2021, will be the year of the vaccine. So that's really how I think about it. The distribution of the vaccine and its effectiveness, especially against variants of the disease, which is mutating, will be key to understanding just how strongly the economy grows. And we think it's going to grow between 6 and 7% this year, which is really big.
Yeah, I know. I read recently that there were some folks that were talking about a 10% GDP in the first quarter.
Yeah.
And you could almost see it building, right? The stimulus that's just recently been approved in combination with vaccines and employment, restaurants, bars. And we actually, the cardboard cutouts actually may be replaced by real people coming up again soon.
Right.
So you start hearing about that and you start watching all of it take place. And it's possible we get a big growth number this year. Let's go to interest rates with regard to that, because of course, recently they have moved. And for our viewers, please, 3.5 to 3 3/4 is still the lowest in our generation, with the exception of last year. So if you missed the window, you're still in, well, let's say, a great position today. You don't see in the forecast, I don't see in your forecast much higher interest rates being forecasted. Tell us your thinking about how maybe the second and third quarter plays out, Doug, in terms of 30-year fixed rate mortgages.
Yeah, the question you have to ask is, how much has the market properly anticipated that growth that we were just talking about, which could be very strong? If the market, and our forecast believes that the market has done a reasonably good job of anticipating that growth, and if you follow the inflation indicators, there's not yet strong indication of inflationary growth. We think that's a story for next year. We think that's a 2022 story. That suggests that we're probably talking about mortgage rates in the 3.1 to 3.2 range over the course of this year. So housing will continue to do well because, as you pointed out, 2020 was the year of historically anomalous interest rates. It's going to be a generational low, maybe a 2 or 3 generational low from our perspective. If employment continues to pick up, the economy is still not back to its potential, but that 1.9 trillion will push it past potential next year. And anytime growth goes past potential growth, you get some inflation. So we do see next year rates pushing up maybe to 3.5, something like that. Still a really good interest rate. It's hard to explain to people that for some of us who are over the age of, say, 35 plus maybe a couple decades, that when we started looking at houses, there were 2 numbers before the decimal point in the mortgage interest rate, 10, 12%. So when you're talking about a 3.5% or even a 4% mortgage, it's possible. We've run some scenarios on interest rates that could get us to 4.3 by the end of next year. Well, let's remember, with the exception of 2020, that's only kind of getting us back to where we were at the end of 2018 when mortgage rates were 4.9. So
yeah, we're both at the age now where we can story tell a little, right? So I can't tell the story that I walked to school for 6 miles in the snow because I grew up in Miami, Florida, right? But I can tell the story of getting my first mortgage at 11% fixed rate. And I thought I got a good deal, like rates were coming down at the time, right? So for folks that are buying today, whether it's 3 or 3.5 or even 4.3, the high point of your forecast for next year, it would still be a great deal. So we chatted before we started about a fellow who works for me, shows up at a house that's priced at 285,000. There's 21 offers in a 24-hour period. And he finished with an offer of 305 and didn't get the property. The good news for all of those that are watching out there that are realtors is there's 20 buyers that did not get the property. So there's 20 left over in the marketplace. How do you think about home prices in 2021?
Well, it's still, the demographics are still strong. So the demand side is going to be stronger than the supply side. Until builders can catch up, you're going to see strong price appreciation. That prices rose over 10%, controlling for property type and all that stuff in 2020. It's going to be probably a little less than that, but pushing 10% again this year. The thing to think about is separate, if you're a buyer, separate in your mind the difference between buying a home in which you intend to live and the services that you're looking from that house are just the services that hosts your family longer term versus the investment value. Because there's going to be a point at which the demographic push will slow and house prices will flatten out. And so the rate of appreciation that people have gotten in the last 3 or 4 years, or even 5 years from house price appreciation, that's going to flatten out at some point. I don't see house prices falling, but household formation took a hit. The number of births took a hit, and immigration was slowed for several years. So there is going to be a demographic pause that's going to come. And I know some forecasters are cutting their next decade level of starts they expect because of those combined factors that I just mentioned on the demographic side. But that's not 2021. 2021 is going to be a strong price growth market.
So there was another conversation that started last year because of COVID, and it was about urban flight. And so whether that's from cities, in certain economies where maybe there was more aggressive governing with regard to opening or reopening, if you will, and or otherwise, maybe based on the conversation we were just having about pricing. From a surveying standpoint and from a sentiment standpoint, your forecasting team, are you hearing that, seeing that, the reality of that play out, or has that been talked about a little bit too much at this point?
No, we can see it. We've actually can track the address of a person making an application to buy a home and the address of the property that they're wanting to buy. So we can actually geographically track it, and we do. And it was a real thing, and it varies by area, and it leaves open a question about what we have learned about working from home or remotely, and how sustainable that's going to be, and should we expect to see population outmigration from the urban core. Now, one of the things that we don't track, but which I was referenced from a study at the Cleveland Fed, is that it's also the case that there used to be people moving into the urban core. They've stopped moving into the urban core. So it's not only that people are moving out, others are not moving in. And so I think it does raise some questions about, say, commercial property values and maybe some multifamily apartment property values, some things like that. Which remain to be seen. But I think with the advance of technology, I think you will see and are already seeing some pickup in places like Tulsa and Indianapolis and Nashville and smaller cities out of the top, say 10 to 15. You've seen a pickup, and even smaller communities as well.
So if we have an audience of entrepreneurs, they're all individual businesses. I run a business, and other folks that are a part of it, of our group, do as well. What are the things that you would tell us to look for in terms of both risk to the upside and then risk to the downside in terms of the forecast that you just put out today? How do you all think about like those things? What are you concerned about that would take the forecast down? And what do you think are other things that could potentially even drive it better?
Well, at some point, there's going to have to be some rational budget management. Now, there's three ways you can pay.
By who?
Yeah, right. Yeah, I'm an independent, so Hawks both their houses, right? The bills must be paid eventually. So there's 3 or 4 ways you can do that. One is you can cut spending. There's shown to be no appetite for that in Washington. You can raise taxes. There's some appetite for that, but it hasn't happened. You can do some combination of both. But what matters is what decisions are made along those lines. If the spending were to continue unabated in things that are purely consumption, then at some point their inflation will pick up, and that's a risk. The reason I focus on consumption, we talked a little earlier about infrastructure investment. That's investment. That's not consumption. So think back to the Eisenhower administration putting in the interstate highways. That was a massive improvement in the cost of distribution of goods and services around the country. Today, it's probably the internet highway is probably the thing where the investment takes place. That's different. That has a payback period, but just giving people a $1,400 check to go on a vacation, that's consumption. And now you're left with the debt with no asset related to that. So that's how I would look at things. One of the scenarios we've run in stress testing the company is a boom bust scenario. So you get 7% growth this year, and then if you put in place a tax bill, you could get the reverse of that next year. So we would see second half of 2022, depending, because the impulse from all this stimulus will have passed through the system. If on top of that you lay a tax bill, you could get the downside. So I would be watching that.
And that would feel like a big reversal, because that's a 14% delta as opposed to just a net 7. It's the 7 growth that you're on today, building your business against, plus the additional 7.
Yeah.
So we should pay attention to stimulus then, and to tax policy. If we were thinking about planning our business in the second half of the year, all things being considered, those are the things that you'd be most likely asking us to pay attention to, or sharing that we should be paying attention to.
Yeah, that's right.
Yeah, I asked about the upside, but it's hard to imagine more upside for housing right
now. Oh my God. Yeah.
When you hear stories about 21 contracts going on one house in a day, I can't draw a scenario. In my 36 years of being in the business, there's nothing remotely close to it. So for those that are enjoying this run right now, it is unprecedented. So put some dollars away. Doug mentioned your family budget, and you should make sure that you pay close attention to taking some dollars and saving some today. Doug, I always ask you this question. I'm going to ask you again, because it is interesting. If you're one of the 20 who didn't get the home under contract, whether or not you start thinking, because it bid up $20,000, should you buy a home? But is it a good time, if you were talking to a family member today, is it a good time, buyer or seller, to buy a home in today's market?
Well, you mentioned the budget, and that's always my go-to is you should have a family budget. And it's a guide, a budget is not iron, because things change over the course of it, but have a budget and understand where your money comes from and where it goes, and how stable the sources and uses of those funds are. And then given what's available today. First of all, you should also, and I've never said this, I guess, as part of that conversation, but you should also have in mind what your current and future needs for housing are. And if there isn't something available today and you're renting and you're comfortable, then just buttress the budget for that time when it becomes available. And don't get excited. There have been booms and busts in housing and regional changes over the years. There will be more that will come. So just don't get caught in a panic like some folks did in the 2007 to 9 time period. Some folks just panicked and said, "I'll never get a house, and so I'm gonna stretch and get this," and it turned out to be really not a good decision. But if at today's interest rates and prices, it fits your budget, then you're buying a home. You're not making an investment. If you're fortunate, it may have some investment attributes over time, but really you're buying a home
To live in it and
to
to
live.
enjoy it, right? Yep.
Yeah.
Doug, thank you so much for being a part of News You Can Use. And thanks for today's forecast, because for those that are in the housing and housing finance business, it's a great forecast to look at 2022 21 with housing sales up 7% on top of last year's 7%. So thanks so much.
You bet. Good talking with you, as always.
Yep. It was great to have Doug again today. Hopefully the information that he shared today and that we share regularly on News You Can Use helps you and your buyers and your sellers make the very best decisions. Thank you so much for being a part of Supreme Southeast and for your support every day. And we look forward to working together with you, providing the industry's best customer experience. Have an awesome day.